Now, I'm very pleased to have with us today two presenters, Ryan McCormack, who is the QQQ Equity Product Strategist representing Invesco's ETFs. In his role, Ryan promotes the adoption of Invesco's QQQ ETF by discussing implementation strategies, creating thought leadership content, and participating in various industry conferences and media opportunities. Prior to joining Invesco, Ryan was an ETF specialist at Oppenheimer Fund. And has received a BA degree in economics from Johns Hopkins University. Now, also with us today, I'm pleased to have Efram Slen, who is the Associate Vice President of Nasdaq Global Information Services. He manages the New York team responsible for product development, research, and content creation. In his tenure, Efram has helped Nasdaq launch thousands of indices, building its offering in both the benchmark and smart beta realms. Prior to joining Nasdaq, Efram worked in the strategy group at ProShares and also worked at The Economist Incorporated, an economic consulting firm. Efram holds a BA in mathematics and minors in economics and statistics from the University of Rochester. So with that, let me put this over on the slides. If you'd all join me in welcoming today's presenters. Thank you both for joining us here today. Over to you, Efram.
Thanks so much, Cynthia, and thank you all for joining on today's webinar, talking about the Nasdaq 100 and investing in innovation. As Cynthia stated, I'm here with Ryan from Invesco. Very excited to have you here, Ryan, talk about the Nasdaq 100 index.
Thanks very much, Efram, and it's great being here, and I appreciate everybody for joining us today.
Excellent. So to kick things off, maybe it's even worth just, I usually like before I get into the Nasdaq 100 specifically, breaking down barriers of potential confusion that folks experience. So when people hear that the Nasdaq went up or the Nasdaq went down on any given day, I want to make sure that generally what you remove that potential point of concern or question. That's the Nasdaq composite. That's usually what the barometer of what people are talking about. The Nasdaq composite, that's an exchange, that's an index that's comprised of all securities that are listed on the Nasdaq Stock Exchange. Now, the Nasdaq 100 index, that's a more liquid, a more tradable version of the Nasdaq composite. It's the 100 largest non-financial companies from the Nasdaq composite. So that's that index, the Nasdaq 100, we're here to talk about today. That index launched 15 years after the launch of the composite. So again, I always like starting off my webinars or talks on Nasdaq 100, making sure I remove that point of confusion or potential, really want to bring that point of clarification. So with that, we'll kick things off. So the Nasdaq 100 is the benchmark of the 21st century industrials. So when I think about Nasdaq, just in general, let alone about the Nasdaq 100, I think about innovation and disruption, right? And we think about names like Apple, like Amazon, Alphabet, Facebook, Intel, right? So many great companies that have chosen to list here that are hallmarks of not only Nasdaq and our exchange on the Nasdaq 100, just of our generation and the economy today. And that's really the story of a large part we're going to be talking about today. So really, maybe we can start off by saying there are two topics, right, within the Nasdaq 100 that we're going to cover. It's going to be innovation and disruption, and as that relates to, frankly, your classification system, your typical classification system. So what is the construct of the Nasdaq 100? How does that relate from an industry benchmark perspective? Like technology is a big thing we're going to be talking about today, and healthcare and consumer services. But beyond that, again, innovation, disruption, how that plays a role in today's markets. Went one slide too far. Excellent. So the Nasdaq 100 index overview. So again, the Nasdaq 100 index and a lot of these names that I was already talking about and showing here, in case I haven't, right? Microsoft, the Starbucks, and so forth. They're disruptors. They're game changers, right? They're companies that are not just influencing our lives on a daily basis, but they're helping form and shape what we do and how we do it in so many ways. And it's kind of, in a lot of ways, similar, contrasting. We've been talking about this for the for the better part of my tenure over the last decade at Nasdaq. But it's kind of the way we think about how the GEs and the Chicago gas companies and really the original Dow Industrials, spurred the economic growth of the U.S. economy about 120 years ago. That's what these companies are doing today, right? They are really fueling, again, not just the Nasdaq 100, but it's really the growth engine by and large for the economy at large, especially within the United States.
And Efram, I think to jump in real quick, what's interesting here is technology in general. To allude to a point that you had made earlier, right? Technology is much different today than it was, say, 20 years ago, right? Where today you're seeing the utilization of technology across various different sectors. I mean, there's countless examples. I mean, you look at the autos, right? Your average automobile today has significantly more computing power or quote unquote technology than the first space shuttle that went into orbit. And so we've seen kind of companies that were initially technology, having websites as being kind of put into this box, whereas today you have companies across financials, across autos, across pretty much every sector out there that is utilizing technology to make their business more efficient and to ultimately deliver to the bottom line. So I think, to talk about innovation is sort of that next level of technology where we can't necessarily just throw it into one bucket, right? It's permeated across all sectors.
And that's an excellent point. And without question, that's what we're going to talk about as we move to. Not only it's a great way to start the presentation, but we're definitely going to get into the weeds on that. And that's one of the hallmarks of the Nasdaq 100 is that it doesn't really distinguish for the classifications, right? It's a step above that, right? So companies like Amazon, that most people hear of Amazon, they think, oh yeah, that's totally a technology company, but they're a consumer company according to every classification system out there. But Amazon is certainly within the internet, the technology realm. So again, fantastic point. So on that line, Nasdaq works with a partner called and they have some unique data across disruptive technology. And this is a great chart kind of touching upon that, kind of kicking off innovation and disruption. So looking at the current companies in the Nasdaq 100, you can see here, so there's a vast array of disruptive technologies from 3D graphics all the way at the left to solar energy and 3D printing all the way to the right. That's the number of companies. This is the percent created on a global basis that have been approved by companies within the Nasdaq 100. So what we're saying here is that 43.5% of the patents, right, for 3D graphics in particular, they have been literally just from the Nasdaq 100 companies. That's 43.5% of all global patents have been approved within the last year, are a result of the Nasdaq 100 companies. That's really incredible, right? This is only 100 companies, and to put that in the context, the number of securities that the research had included in the patents that are approved, it's over 11,000 securities. So that's a really monumental point. There is that looking at the cross section of disruptive technologies here, how impactful and how research and development driven these companies are. The fact that it's not just one or two of these disruptive technologies, it is a very, very vast set of data, and it's 35 disruptive technologies. We're including the ones with the most contribution here, but they touch all 35 disruptive technologies. It's pretty
incredible.
incredible. Ryan, any thoughts?
Yeah, I mean, just as you look at the technologies themselves, to kind of harp on my previous point, I mean, they're permeating across sectors, right? And if you just kind of scroll very quickly with some of the names, I mean, it's stuff that you hear about fairly often, right? You're looking at drones, you're looking at the Internet of Things, you're looking at blockchain, which is imperative for a lot of financial firms and others, robotic surgery for obviously healthcare, big data, cyber. I mean, these are all the kind of next generation of themes that we're going to see across the market and themes that are going to, again, permeate across sectors. And it really is staggering the numbers of patents that are brought in just by these 100 companies across these themes.
Absolutely. And with that, we want to get into what is technology? What are what's some of these classification systems? So one of them in particular, it's the Global Industry Classification Standard. What those changes are and what they mean to you. So there are some changes that were instituted back in late 2018, and why that means something is the S&P 500 utilizes the GICS standard for their sector indexes. So, and that's kind of a critical point that we want to make sure we touch upon. So frankly, what's under the hood? What are you getting when you think about getting exposure to the S&P 500 Infotech Index? And that's what's good we want to touch upon here. In particular, on this slide, it's pretty straightforward that prior, right, to the communication services industry being in existence, which includes names like Facebook and others, which we'll see on the next slide, they were in the Infotech Index, right? They were in the Infotech S&P 500 Index. But after the GICS change, they completely fell out. It is a completely different basket right now. You removed a lot of names that you maybe would have thought would have been technology, but again, given this change that it was instituted, you're getting a definitely far different layout maybe of securities and weight that you would have expected. And maybe let's get into some of those names that could help explain that. So Facebook, Alphabet, AT&T. So some of these maybe wouldn't surprise you, like AT&T, Verizon, and others. Those don't surprise me. Same with communication services, and maybe Facebook and Alphabet don't either. But when you're looking to get into exposure from a technology perspective, that's the kind of thing where those names historically have always been technology. So that's, again, just something to keep in mind and think about whenever not only you're making investment decisions, but just think about what type of exposure you're trying to get. Where do those names actually fall? Where do they fit into the context of your not only normal portfolio allocation, just within products that you actually own? You might not even realize, some folks might even realize that some of these changes actually occurred. And that's where we wanted to make sure we touched upon the Nasdaq 100 versus that S&P 500 Infotech Index. So on the left-hand side, you have the S&P 500 and information technology, and the Nasdaq 100 on the right. And you can see some of the names are certainly going to be in from the top 10. In both, not again, Apple and Microsoft, not surprising. But Amazon, it's consumer discretionary. Alphabet, Facebook, right? Comcast, communication, right? So that's the main thing we wanted to hit home here with this quick slide, and really touch upon. So you know that XLK, again, as the example of the ETF that we had on the other slide, that's what tracks the S&P 500 Infotech Index. That is a much different basket, especially from the weights at the top, than the Nasdaq 100 with the QQQ ETF that tracks that.
And QQQ is the ETF that tracks the Nasdaq 100. So if you're looking for exposure to the Nasdaq 100, QQQ would be the way to gain that exposure. And when I'm out in the field, a lot of the common misconceptions that I'll get, specifically, as you look throughout history, is, oh, investing in QQQ is a tech ETF. That's how I'm going to get my tech exposure. Well, if you look on the right-hand side, it's much more than just tech. Right? If you want to look at your regular industry classifications, you're going to get exposure to consumer discretionary. You're going to have exposure to healthcare. You're going to have exposure to communication services in addition to tech. But again, this is kind of breaking down the construct of putting the Nasdaq 100 into one sector box, right? Which is why we're going with the narrative that investing in the Nasdaq 100 by way of QQQ means that you're investing in gaining exposure to innovation, right, across sectors.
Absolutely, and again, that's where this last slide just hits home in terms of what occurred and transpired in GICS. Again, finalizing that point there, how that translated to the Nasdaq 100, and the answer is it doesn't. Right, the Nasdaq does not utilize GICS as part of its index methodology, and further, right, this change does not actually show, again, not only does it not impact the Nasdaq 100 because we utilize a different classification system, utilize industry classification benchmark, which is ICB, but further, it just shows the delineation of what looks like the pre and post GIC sector changes to what Ryan was just saying. We're going to continue to touch upon is the Nasdaq 100. Sure, it's very largely tech-based, but it's way more than that, right? It is the consumers, it is communication services, it is healthcare, and that is huge, and that is what we're going to continue to touch upon today. So the Nasdaq 100, like I started out the presentation with, it launched 15 years after the Nasdaq Composite. It was in January 1985. It's the 100 largest non-financial companies listed on the Nasdaq stock market. Market performance and technology. So this is a fun slide. So it touches upon two very critical things here. It talks about the Nasdaq 100 from a price perspective, really from a growing, literally growing from a price perspective, but also looking at it from in relation to sales and really fundamentals of earnings. So on the left-hand side, the left chart, you have the index price and the sales per share, looking how that's growing and how that is playing out over the last almost 14 plus years. And then on the right-hand side, you have the PE and how that's actually been relatively stable over the last several years. This is a slide that we touch upon on a very regular basis here. In looking at the annual returns of the Nasdaq 100 versus the S&P 500, it's been quite a run that we've experienced. So notwithstanding, of course, historical performance is not indicative of future results, but the Nasdaq 100 has outperformed the S&P 500 9 of the last 10 calendar years. On a cumulative basis, it has vastly outperformed the S&P 500 at the same time, getting exposure to those large and mega cap names that we all know and love. And it's critical that at the same time, our PE has been relatively stable, right? It's not like we're doing this without strong earnings and strong sales. And again, that's what that last slide and a number of other slides talking about the fundamentals over the presentation are going to touch upon here. So from a straight performance perspective, through the end of February, despite the beginning of the pullback that we're experiencing, the Nasdaq 100 is more than double the return of the S&P 500, again, over about 13 plus years here. And this next slide now shows it on an annual basis, breaking it out in table form. What I actually like about this table more than anything is you're showing the correlation. Not surprising, this is going to be very relatively high, well above 0.9 in almost every year, even closer to 0.95 and above. Again, that the largest names in the Nasdaq 100 are in the S&P 500, right? You're going to get a lot of that same exposure from a weighting perspective, as well as classification coverage perspective. So that doesn't surprise. Then when you look at the volatility, and this is something I've talked about on other calls and webcasts and talks, as well as written some research on, the Nasdaq 100 should be by and large more volatile. In most instances it is and should be, but for two really core reasons. Number one, the Nasdaq 100 has 100 companies. The S&P 500 has 5. So there are 5 times the number of companies. So it's able to have more diversification in that respect. But two, the Nasdaq 100 is able to get higher weights to some of those names. So as a result of having smaller names, we're having more exposure to those names, those 100 names. And again, those names then are driving returns up and down on a more volatile basis as a result. Now, the other thing, again, critical here, if you're looking at the table and recognizing volatility, it does not just happen on the downside. Sure, largely when you hear volatility and you think about it, that's kind of the first thing that comes to mind. But volatility happens in both ways. So if you look at, perfect example, 2019 or 2017, right? The difference in volatility is about 4% higher for the Nasdaq 100, but in each of those years, the Nasdaq 100 had almost 11+% return on the Nasdaq 100 had over the S&P in 2017, and in 2019 had about just under a shade under 8% return for the Nasdaq 100 over the S&P. Now that story continues to transpire here. So if you look at this chart shows historical volatility utilizing the SIBO as well, the SIBO S&P 500 as well as the Nasdaq 100 volatility indexes. So those are the VIX and VXN indexes respectively. Again, not surprisingly, the case that the implied volatility of the Nasdaq 100 is higher than the S&P. Again, for those two main reasons that I touched upon already. However, again, very, very similar implied volatilities. You're not seeing spikes up in one way versus the other without having, frankly, a very similar corresponding reaction there.
And being out in the field, this is something that I get quite a bit when I'm out and discussing QQQ. It's, well, you know, it's the Nasdaq 100 and QQQ is much more volatile than the S&P 500. Well, number one, it's not much more volatile. There's some excess volatility, which is to be expected. As Efram said, it's 100 names versus 500. Our 100 names lean much more growthy than S&P 500, right? There's kind of a significant lack of value within the Nasdaq 100, meaning, you know, value-driven names. So, you know, number one, I'm a very big believer in knowing what you own. And, you know, you're going to be owning 100 companies that are more growth driven. So that volatility, that excess volatility is to be expected. That being said, it certainly isn't out of proportion. And as you look at market movement and movement of the volatility of either sector, or excuse me, either index, they do move very similarly in terms of direction. And this next slide, Efram, I think kind of talks about some of that excess volatility.
Yeah, and absolutely. Absolutely. And what I love about this chart, it's directly touching upon, we just covered the last several slides. It's showing both the volatility as well as the return differential in one chart. So you're able to see here in green, what's the, and you know, on a 1 year basis, what's the difference in return for the Nasdaq 100 versus the S&P 500 on a rolling basis? And in orange, what's the difference in volatility? So again, the excess return here heading into the end of really actually not just the end of the year of 2019, but into the end of February of this year, the annual return, excess return of the Nasdaq 100 is actually going up at the same time as the difference in volatility is going down, right? That is something, again, that we're touching upon, but you're directly seeing here play out real time. Now, what's most critical, this is the part that I like looking at and pointing out, is that, yes, the vol is higher almost on an annual basis here, right? This is the zero. Right, you're almost on an annual basis. The return, though, in almost the entirety of the history, other than barring a few instances, right, that I'm circling in early to mid 2013 and in parts of 2016, right, by and large above zero, and not just above zero in a small capacity. We're talking well in excess of 5% on an annual basis.
So with that performance, you are being compensated for that excess volatility by the way of excess performance in the vast majority of these timeframes.
Absolutely. So coveted placement, the 100 that make the Nasdaq 100 index. This is one thing that I think has blew a lot of people away when we first showed it to them, and it continues to surprise folks. So on our research team, we did a study. We wanted to look at what's driving the Nasdaq 100, because, you know, we always hear, you know, those names, those mega cap names at the top that are very, very, you know, well known, that are helping drive performance, sure, but they're actually surprisingly not the better performing names. So in this research, we looked at the top 50 and bottom 50 names from the 100 and ran a back test and did some analysis and said, what are the names that are performing best on an equal weighted basis? And actually, if you see here on the right, the bottom 50 are actually outperforming the top 50 since the end of 2001. Very, very interesting results. And then if you look on the left-hand side of this chart here, it's looking at the price to book ratios within the Nasdaq 100 as it relates to both the top 50 and the bottom 50, and how similar they actually are. So you're not losing anything here, right? This is showing the consistency of performance from both sides of the spectrum with very, very similar and strong fundamentals. That's a very, very key component here, is that it's not just that it's top heavy, it's across the spectrum. You're getting that great exposure, those great returns, but with strong valuations. The decade of the Nasdaq 100. Yeah, this is something amazing. We've actually continued to say because it's been, the story has continued over the last couple of years. We like in that we like actually touching upon two things here. We like showing in the right-hand side of the chart what's the industry classification benchmark, the industry breakdown of the Nasdaq 100 versus the S&P. So we started to touch upon that earlier, but here we're directly showing you, right? What are the exposures from an industry perspective of the Nasdaq 100 in blue and the S&P 500 in gray? And you can see from the Nasdaq 100 perspective, in industry, technology is 57%, while the S&P is 23%. Consumer services, it's 22 for Nasdaq, 13 for S&P, and then healthcare, the Nasdaq is 7 and S&P is 13. Then if you look on the left-hand side, what's driving growth in the U.S. large mid-cap space? That's what that chart is. What are the 10-year sales growth across these industries? Just in general, the entirety of the more or less 1,000 largest names in the U.S. space, and technology, healthcare, consumer services are the top 3 performing industries in that fashion. So from a full year basis, looking at the Nasdaq 100 and some of its components, it's always interesting taking a look back and seeing what was helping drive the index. What were some of the top performers from a returns perspective, but also from an earnings perspective. So some names you might know, and they're very top of mind. Others, frankly, you might not. So if you look through here, AMD in 2019 had a phenomenal year, almost 50%. Index weight at about 50 basis points, or 60 basis points rather. But and then the bottom of the top 10, Apple actually had almost 86% return, and its weight at the end of the year was 11.6. And go over to the right-hand side of the page, you can see it from a growth perspective. Yes, Alexion Pharmaceuticals had an amazing earnings growth year. Going down the list, though, and again, maybe you know Alexion, maybe you don't. There are a lot of names in here, though, across the top 10 that folks certainly are aware of, that their earnings growth is well in excess of 50%. And again, that's phenomenal in and of itself. And names like Lululemon, Qualcomm, Insight, and so forth. You know, Ryan, you were just touching upon this too, and from a S&P versus Nasdaq perspective, you know, what's your take on the cap size? What are the types of questions you experience when it comes to the size of the Nasdaq 100? Do you continue to hear, you know, that the Nasdaq 100 is, you know, what the breakdown is? Because this is something that on our side we really wanted to hit home on, that the Nasdaq 100 is absolutely a large cap index. That's what this slide it touches upon here.
Yeah, and I think when you're out in the field and that kind of goes hand in hand with some of that volatility, it's, you know, the volatility and preconceived notions about Nasdaq being very tech heavy. It's, you know, in some cases folks are thinking, oh, you know, these are very, very small companies that are just ramping up their earnings. Well, you know, kind of just the opposite. As Efram had said, you know, Nasdaq 100 is very firmly a large cap index, and beyond that, you know, a lot of its components, even though they are showing significant earnings growth, in many cases they are large cap companies. So when you look at the breakdown, I mean, you're looking at the 100 largest companies listed on the exchange ex financials, and with that lends itself certainly to that large cap profile. So in investing in Nasdaq 100, you are looking at very firmly that large cap growth bucket.
Nasdaq 100 by the sectors. So, and if you look at year-end performance here, sorry, year-end construction here, we wanted to make sure we broke that down again in a different fashion here. So we have the weights from an industry perspective. We're also showing the contribution to return, the pure return, and the benchmark return. So it's critical here from a sector perspective is understanding what this means and what you're getting exposure to, and again, the comparison. So the benchmark return, that's literally what are the Nasdaq US industry benchmark indexes and how they performed over the course of 2019. The pure return is what are the names within the Nasdaq 100, how they performed. And the contribution to return, that's literally what was driving the returns of the Nasdaq 100 from an industry perspective over the course of 2019. sector exposure matters, right? So from an over 10, really over a decade of performance here, what's critical here is what we're trying to show is that looking at all global sectors, it's not just in the United States, right? That certain sectors are continuing to, industries are continuing to drive the economy. So if we look here, technology, and this is going to be a similar pattern, technology, healthcare, and consumer services are the top three performers. Yes, you can start seeing the dip in of the current market events. I mean, that's the driver. What we're touching upon here is that what you're getting exposed to and how you allocate in either global or U.S. fashion, you have that exposure. And then that's the similar story here for technology versus financials. And again, global or U.S., technology is absolutely the front running performance, and then financials is the laggard. And again, that's critical that we're breaking this out is because financials, of course, are excluded from the Nasdaq 100. And lastly, industries and dividends. So industry exposure, when pursuing dividend growth, you know, it's extremely important to know what you're getting exposure to, and just like all things, where that growth is actually coming from across the spectrum. Starting in 2012, I really feel like that was a big turning point. Once Apple started paying dividends, the technology industry in and of itself was already paying dividends with companies like Microsoft and others that were already out there paying dividends. Apple started that shift. I really feel like that was a big turning point for the industry. And over the last decade, you can really see the growth of how that's transpired. And again, we've been making this chart for the better part of 5 years, and technology has been the driving force here. And we'll see actually on a later slide how that dividend framework has actually transpired in actual dollars. But here on a percentage basis, phenomenal growth in technology, healthcare, and again, consumers towards the top. Financials actually come into its own of late. It was actually more towards the bottom over the last couple of years prior. So very interesting stuff, but technology, again, continuing to lead the pack here.
And along those same lines, I think what's very interesting is this is almost another comparison to these companies are much different than what they looked like 20 years ago, right? If I had told you that some of these companies were going to be initiating or growing their dividends, most people would have laughed in my face. But now you are looking at these technology-driven companies that are finding new ways to deliver value to the shareholder, in this case, dividends, which would have been just beyond comprehension 20 years ago. So with that, you know, going back to technology as the new industrials, you know, these companies are very mature. They are very stable businesses, and they are, and you're looking at their, which we're going to get into, their commitment to research and development. It is being driven to the bottom line, and they're finding ways to not only earn cash, but return that cash to the shareholder. So that dividend figure for technology obviously is just off the charts.
Research and development. So we started to touch upon this earlier with the slide with the analysis from the UNO team, and this is something that really helpful to kind of get some dollars in the research and development expense, kind of showing, again, comparing the Nasdaq 100 to S&P, what's the driver of innovation, economic growth. So on a dollar basis, looking at the Nasdaq 100 names themselves at 10.5 billion, the S&P 500 itself at 4.8, then the names that were only in the S&P 500 at 2.8. Again, really interesting to see where the growth that's coming from the Nasdaq 100. Just in the S&P 500 alone, it's about $2 billion. So again, some of those names are driving, and again, that's critical here, that the names are driving the economy at large, not just in the Nasdaq 100, not just at the S&P 500 itself, but across the entirety of the landscape. And that's where it continues to transpire, looking at it as a basis of R&D, comparing it to sales. Again, higher, not surprising, because R&D is higher with the Nasdaq 100, but also, again, showing how that the S&P 500 only, again, removing and stripping out those names at 2.8% versus 8.8%. That weighted average R&D as a percent of sales, very big drop off there.
And what this R&D, what these R&D figures, we're trying to tell, and the story that they're trying to, that they tell, is the fact that innovation is very hard to quantify. Right, Efram did a great job on the earlier slides. It talked about the patents and a lot of those underlying themes, right? Big data, cloud computing, etc. Those themes didn't exist as recently as 5 or 10 years ago, right? So these companies' consistent commitment to R&D and reinvesting in their business to try to find new ways and innovative strategies, products, markets, frankly, innovative ways to make money is something I like to say. You know, that commitment has sort of propelled them as the leaders of this new economy. So again, it's sort of hard to say, oh, this company is innovating because of a new product that they've developed, right? The commitment and the spend of R&D, both in terms of absolute and as a percentage to sales, helps to describe the fact that these companies are trying to reinvest to solidify their commitment to their innovation. And with that, the following slides are going to show that R&D is working and starting to trickle down to the bottom line.
And the Nasdaq 100 is not just U.S. based. That's something that's critical that we continue to touch upon. There's really a global exposure, and that's something why we really wanted to bring that back in time over the last 16 years. You're able to see the range has been really between 40 and 45%, that the average foreign sales is just, while it's gone up quite a little bit here and there over time, it's been by and large actually a very global exposure. And again, from an index weighted perspective, again, it's certainly shown some more growth there from 36 at the bottom to 46 in 2019. But again, similar story, and that's something we wanted to make sure we touch upon, is that you're not just getting exposure to U.S. names. The index fundamentals. So since 2003, and again, the biggest point on this slide to touch upon is the annual compound growth rate from earnings, revenues, dividend value, and PE. So over the last 16 years, that the earnings, revenues, dividends have all exploded, while at the same time price has continued to go down, but it really contracted, and the PE is actually come down 9%. That's critical, right? To point out that fundamentals have exploded, the price has done as well, but actually you're getting a stronger PE over that time frame. And the biggest misconception that we continually hear, that Ryan touched upon earlier, is that these names, they aren't necessarily, large cap. They aren't necessarily giving you the right exposure to those large cap names, or those names that are actually making money. But that's not true. They absolutely are. The fundamentals are absolutely resulting in significant outperformance, and that's really driving that outperformance. And that's what this chart touches upon here. And we have 6 different sets of charts, and showing within this chart 6 different sets of bar charts here, showing earnings, revenues, and dividends, and the multiplier of what's occurred over the last 16 years. And on an earnings basis, the Nasdaq 100 went up 22 times, S&P 4 times. On a revenue basis, Nasdaq went up 6.5, S&P at 2 times, and on dividends basis, again, this is more we're going to see soon, and from a dollar basis, but on an absolute return perspective, there it's 40 times versus 3.5 times. And here's the dividends paid slide, and this is really what we wanted to show here, is that in 2003, the Nasdaq 100 companies only paid $2.2 billion in dividends. Fast forward to last year, almost $90 billion were paid out in dividends, and that resulted in a dividend yield of, again, about 10 basis points in 2003 to last year at just under 90 basis points. At the same time, the cash to debt ratio has actually been pretty strong and stable, and that's something when you think about R&D and expense, another thing to keep in mind, as well as where the dividends are going, and is there actually money there to take care of that. And cash has continued to be a big player on the balance sheets of all these companies. While sure, the debt has started to trickle up, it's critical to know that these companies really are positioning themselves well across. Earnings. So the Nasdaq 100 versus the S&P back in 2003, again, The S&P 500 very strong at 275 billion at that time. Nasdaq very small at just under 16 billion. So today, again, very, very large multiplier, just over 340 billion, and S&P at 1167 billion. Again, that growth is pretty high for the S&P in and of itself, but really, really massive growth for Nasdaq at just under 2,100%. And similar story for the earnings and dividends. That you'll see that here on the revenue side. Nasdaq 100 has gone from 400 to 2,700 billion in massive growth there, but at the same time, while S&P a little more than doubled. Again, that's really the story of what we're trying to touch upon. That Nasdaq, the S&P has absolutely grown as the U.S. markets have grown. The Nasdaq 100 has that far larger multiplier, far more exposure to that fundamental growth and that fundamental shift in the technology space over the last 16 years.
And you can see that. I mean, you look at the absolute numbers of those past 3 slides: dividends, earnings, and sales, and the numbers are staggering. And just to revisit an earlier point, these are not your parents' technology companies, and we're going to start to go into that in the next 2 slides. But they look very different than 20 years ago, 10 years ago, 5 years ago, right? You look at Amazon and Microsoft, and they are now 2 of the largest players in the cloud computing space. Right? A few years ago, Amazon was Amazon Prime, right? They delivered stuff to your doorstep, and they still do, and they did it really efficiently, and that's why we love them. Well, really, their commitment and growth to the cloud computing space is one that's really been driving a lot of that bottom line. Microsoft has moved away from just being a software company to also being a tremendous player in the cloud computing space. And I think the ability not only to, again, reinvest in research and development, right, to further that innovation, the commitment of these companies to be nimble has served them very well. And over those past 3 slides, when you're looking at those absolute numbers, I mean, that's all you need to tell the story. Right, so the fact that they're able to continue to innovate and be nimble, that really has been transferable to the bottom line. And Efram, if it's all right, I think I'll take these next 2 slides because this is probably the biggest question or the biggest source of pushback that I get when I'm out in the field and talking about QQQ and the Nasdaq 100, and it's, well, is this another 99? We believe no, because to all my previous points, these businesses look a lot different, and a lot of it is driven from valuation. So as you look at it, market cap to net income now relative to the height of the tech bubble, which was in March of 2000. The 5 largest tech companies that were out there in the S&P 500 were trading at a 77.8 times market cap to net income figure at the height of the bubble. Now, as you're looking at the top 5 largest holdings within QQQ, or the top 5 largest members of the Nasdaq 100, 29.1 times. Right, so these companies would need to more than double, significantly more than double, to be trading in line with the valuations that they were at the height of the tech bubble back in 2000. If you go back to that, I mean, the earnings just weren't there. The sales weren't really there. And, certainly there was a level of irrational exuberance because this whole technology, explosion was just in its infancy. Back then, you really just needed to have a website to be considered a technology company. And I'm sure pretty much every one of you on this call can point to at least one company that you remember back in 99, 2000 that had a website that crashed and burned, right? There were no earnings, there were no sales. The landscape of technology has changed to the point where there are earnings, there are sales, and they are significant. And they have been growing significantly over the past 20 years. So the valuation story is the first to kind of point the finger to and say, look, we're in a very different environment than we were 20 years ago. Beyond that, as you look at sort of the way that, again, these companies are not only capitalized, but beyond that, the underlying trading within these companies tells a very interesting story. Right now, cash as a percentage of market cap, 11.8% relative to 2.3%. So you're looking at 5 times the cash on balance sheets on these top 5 companies than 20 years ago. Right, so not only, number one, does that say, okay, well, earnings again are going down to the bottom line, and that gives them more flexibility for things like dividends and CapEx, et cetera. But also they've got a ton of cash, which will allow them to hopefully weather, market volatility of course, bouts that we're in the middle of and have seen over the past 20 years. But beyond that, we're not exactly seeing the irrational exuberance that we did back in 2000. If you look at the 1-year average return of that tech bubble, 184.2% in those names. The 3-year average return, 611.9%, right? People just wanted exposure to tech. They didn't understand what the businesses were. They didn't understand how these stocks were trading. It was tech, it was a website, and people needed exposure to it. Now, because not only do we have significantly more information on kind of what makes a technology, what makes a technology company work, what makes a technology company successful, but beyond that, I think these companies again are much more well established, right? They're larger cap in nature, so you're not going to necessarily see those same violent swings or unbelievable run-ups like we did in the tech bubble. So you're seeing much more muted returns, albeit great returns, right? 31.9% on the 1 year and nearly 100% on the 3 year, but you're not really seeing that same sort of again, I hate to use the same term, irrational exuberance that we did 20 years ago. So, these two are kind of the driving slides as to what I point to say, no, right now is not really like 99. We're in a much different market environment. And beyond that, we're in a much different environment for these underlying businesses and stocks. Efram, anything you want to add there?
No, that's phenomenal. I love it, and that's something that again we get a lot here internally, and asked as well from media and folks is what's the environment now like different? Is it still a tech bubble now versus really how much different is it now versus what it was today? Are we in a new tech bubble, and how does that relate? And everything you touch upon, very awesome supporting points. Of why today is different. I have to obviously leave our disclaimer up, just make sure folks know that it's very critical. These are the views that from Ryan and myself, past performance, not indicative of future results, and so forth. Our contact information here as well. That Ryan, any maybe questions that to round out the presentation that you'd like to ask me, or we can kind of wrap up the call today?
Yeah, I saw one interesting question, and Efram, I'm happy to help out here if need be. It was about NVIDIA and them being innovators as well as being very heavily involved in the electric vehicle market. Any points that you want to touch on, maybe not just on NVIDIA, but, companies like that we've seen their weighting in the Nasdaq 100 increase, right, in having that exposure within the index?
Companies like NVIDIA are very interesting, right? They are extremely invested in R&D. So yes, they've absolutely grown quite well on a price basis, but they're one of those preeminent companies in that patent research that we were talking about earlier. Really phenomenal attribution to a number of disruptive technologies, and again, that's from the patent side. But outside of that, Ryan, maybe there's some other aspects you want to touch upon specifically on NVIDIA or other organizations.
Yeah, maybe other organizations. Just when you're looking at it as a whole, I think this is also the power of the index, right? When you look at what a large component NVIDIA has become, another one of at least recently that has taken a similar trajectory would be something like Tesla. These companies' innovation you can see it in the Nasdaq 100, right? They become a larger and larger percentage of the index because their business results continue to surprise to the upside. So again, sort of along those lines of innovation, you can get companies like NVIDIA that has done unbelievable stuff in mobile chip graphics, and originally very much in like computer gaming, that has again innovated and moved their business lines and diversified their business lines to the electric vehicle market, which kind of plays hand in hand with a company like Tesla. But you can see as these companies continue to evolve, continue to mature, and continue to diversify across business lines, becoming a larger and larger percentage of the index. So that's sort of like that classic growth and innovation story that we've seen, countless times with Nasdaq 100.
Absolutely. There was another question related to QQQ and reinvesting. Anything you want to touch upon there, and how you can maybe point them to the right folks to answer those questions?
Sure. I'll take that offline and talk with we can talk about that online with capital markets teams. But yeah, I mean, in terms of reinvesting those dividends, right? Not only are you seeing dividends from QQQ, and I joked around on a recent media opportunity that I don't think you're necessarily going to be knocking the door down to buy QQQ for the dividends, but it is a nice little bonus and something that I don't think that you would have expected 10 or 20 years ago. So the fact that we're even having the conversation about reinvesting QQQ dividends, I think is a testament to the underlying companies within that index.
Absolutely. And I guess one of the last questions, we got this from a few different people about the presentation materials, the video content, and yes, that should be made available later. I believe those are all the questions. So that maybe Cynthia, Ryan, unless there's something else that you wanted to close on, I guess I'll thank everybody for their time, and thank you for joining today. It's been a pleasure, Ryan, speaking with you and talking about the Nasdaq 100.
Yeah, Efram, thank you so much for walking us through construction of the index. Some important data points to see, and everybody for joining us today, and obviously a very busy day. That being said, our contact is there, so please don't hesitate to reach out with individual questions on the index, on the ETF, and it's been a pleasure talking with you all.